Here we are. All right, so we're here again. And so why don't we get started? This is our second session. And so remind me, did I manage to send you the slides for this week? That was my intention. Did you get them?
Yeah, you sent the slides and I
Okay.
received them.
Oh, good. Okay, great. Yeah, I just realized just a second, I wasn't positive, but I'm glad. Okay, I must have done it as soon as the class was over, and then it's been a week and I just forgot. That's good. All right, so we're ready. Week 2 this week, we're looking at, let's see what's going on. Okay. Actually, while we're at it, why don't we just take a quick peek at what we were doing last week? Just a quick reminder. Last week, we were looking at a broad overview of the 4 basic types of derivative securities: forwards, futures, swaps, and options. And we got quite a bit done here. And so, yes, so this week, we're just going to take a step back and dive more deeply into each of these derivatives just to get a better feel for how they're priced in the marketplace. Okay, so let me just quickly turn off some of this other stuff I've got open, and then we can get into it. All right, so this is section 2 in our introduction to derivatives. And so we're going to, in this session, review the basic properties of forwards and futures contracts, see how to calculate the forward price of an asset, understand how and why futures contracts are marked to market, and understand why futures prices converge to spot prices at maturity. Let's see what else. Oh, understand the relationship between forward and futures prices, and then finally learn how to hedge risk with futures contracts. Okay, so it's a very ambitious agenda here. So why don't we start at the beginning with a quick review of forward contracts. And you'll recall from last week that a forward contract is simply an agreement to either buy or sell an asset at a specified date in the future where the price is determined today. Okay, so you're locking in the price at which you're allowed to buy or sell something in the future. And so this is why these are such powerful hedging instruments, because you can specify any conditions you want in the contract. You can choose to buy or sell any asset. You can take delivery on any date, and the price, of course, comes from the market. That you don't choose, but you can decide what asset to buy or sell and when to take delivery. Then the price has to be determined using a formula like the one we're about to look at. So what we're about to do here is look at the general approach to calculating what are called forward prices, which means the prices of assets that will be delivered in the future. So we'll see that the formula depends on whether or not the asset that we're buying or selling provides a stream of cash flows to the owner. And if so, we have to take that into account in our calculations of the forward price. Some of these do, some of these do not. For example, gold does not provide any income to the owner. Currencies, on the other hand, can provide a foreign rate of interest to the owner if they're invested properly. Bonds provide interest payments to the owner. Stocks may provide dividends. So each one of these may fall into a different category. So we're going to start with a case of assets that do not pay any income to the owner. Okay, now, gold being the perfect example. So here's the formula. Now, what do these variables represent? The subscript is time. So it's traditional in these models to let 0 represent today. Okay, so in other words, when you see t equals 0, like you do here, that means this is today. And often a subscript like 1 or 2 represents a specific number of years in the future. All right, so if we saw F1 here, most likely it would represent the forward price 1 year in the future, although it doesn't have to. There's other possibilities as well. All right, so what's going on in this formula? Well, F is equal to S, which is, of course, the current spot price of the asset. Let me just remind everyone, this S is the spot price. And that, of course, is the price that you would pay to buy this asset now. This is the forward price. But specifically this is the forward price that applies to this time period, capital T. So if T, for example, is 6 months, then this would be a 6-month forward price. And so what that means is I would be allowed to buy this asset for delivery in 6 months at this price F0. R here, as you can see, is what we call the risk-free rate of interest. That usually means it's the yield on a treasury bill or something along those lines. Like, for example, if T is 6 months, R most likely would be the yield on the 6-month treasury bill. That's an important detail. We'll see more about that later on in the course. Why is this a risk-free asset, a risk-free rate, as opposed to, let's say, the return to a bank account or something like that? There's a very, very good reason for it, but we won't be in a position to go over that until we get through a little bit more content here. But anyway, so we'll just call that the risk-free rate. And of course, E is a constant, which is approximately equal to 2.71828. What's actually happening here is that we are actually, what we're seeing here is that in this formula, I'll write this in the next slide here. In this formula, the forward price is the future value of the spot price. Okay, now what does future value mean? The future value represents what an asset will be worth at a specified point in the future. Okay, we often see this associated with bank accounts, for example. Let's say that I told you that, suppose, for example, we deposit $1,000 is deposited in a bank account for 2 years. The bank pays a rate of interest of, let's say, 4% compounded semi-annually. What will the deposit be worth in 2 years? All right, so the key detail here is that the interesting part is that the interest is compounded semi-annually. And what that means is that instead of giving you 4% once a year, the bank is actually offering to pay you 2% twice a year. So this question is equivalent to saying, what is the future value of this sum? So in other words, how much will it be worth in 2 years? Now, we can do this in a couple of different ways. We can take the long approach. Now, notice that the starting value or principal is $1,000. We'll let P represent principal. And the rate is 4%. Rates are always expressed on an annual basis. It's a 2-year investment, so I'll put 2 here for 2 years. And then the compounding frequency, will describe this with the letter N. That means interest is paid or compounded twice per year. Okay, so how much will we have in this bank account? So after 6 months, so we start with 1,000, and then the bank is going to give us half of 4%, and that's going to leave us with $1,020. All right, so it's 2% because it's only 6 months, half of 4%. After 12 months or 1 year, we'll have 1,020 multiplied by 1.02. And if you multiply that out on your calculator, you'll end up with $1,040.40. Okay, now then we have to continue for 2 full years. So after, let's say, 18 months, we'll have 1,040.40 times 1.02, 1,061 point, let's say 208. And then after 2 years, how much will we have? 1061.208 times 1.02 again. And that leaves us with 1082.43. So there's a reason why I did this step by step. So you can see after every 6 months, we're credited with another 2% worth of interest, so that after 2 years, we end up with 1,082.43. And so what that means then is that the future value of the original $1,000 is 1,082.43. Now, we didn't really have to go through all those steps. There are formulas that we could use to do this directly. For example, let me just type one in there for you. All right, here we go. So a formula that you might see used to accomplish this is okay, this is a formula that you sometimes see. Every book is different, of course, but this is a standard formula for calculating what we call the future value of a sum, because it's a single deposit that we are making here. And this is the formula that we could have used. Let's see. Okay, so that's the formula. So what is this all about? So A is the future value, P is the principal, R is the rate, N is the compounding frequency, and T is time. Let's see. I'm trying to make it look as neat as possible. T is time. No, that should do it. Okay. So if I plug in these numbers, what's going to happen all right, let's find out. So we'll have 1,000 times, in parentheses, 1 plus 4% divided by 2. And so the exponent is 2 times 2 because it's 2 for two times a year, and also 2 years just by coincidence. So basically what you've got here is 1,000 times 1.02 to the 4th power. And guess what? When you plug in those numbers into your calculator, you get the same thing we found. When you round to dollars and cents, $1,082 and 43 cents. So that formula saved us a lot of grief, okay, compared to all the work we had to do before. Okay, so this is what you would do to calculate this directly without going through all those steps. So this is the future value of our original $1,000, and it's calculated with this formula, which tells us, and again, it's based on the idea that we started with 1,000. Then we have a rate of interest of 4%, which is paid out twice a year for 2 years, and we end up with a future value of 1,082.43. Now, it turns out that with a lot of financial models, especially with derivatives, what we have to do is the following. We're going to make the following assumption. Suppose that instead of interest being compounded twice a year, it is compounded at every instant in time. In other words, an infinite number of times. The formula then becomes, and it's very simple, surprisingly so, A equals PE to the RT. Okay, so actually I have to turn that into superscript. And E is, of course, the constant we saw just a couple of minutes ago. In other words, 2.71828, et cetera, et cetera. Okay, so why don't we plug in the numbers again, and this time let's see how much of a difference that ends up making. So let's see, we started out with a principal of 1,000, R is 4%, and this is 2 years. Okay, so P is 1,000, R is 4%, T is 2. So I'm going to use this formula now and see how much of a difference it makes if I use this approach. So 1,000 times E raised to the 0.04 times 2 power. And so when you multiply that on your calculator, you'll end up with, it's slightly more, it's $1,083.87. No, sorry, that's not right. 1,083.29 compared to before when it was 1,082.43. Okay, now, so what this means then is that if the interest is continuously, oh, and by the way, when interest is compounded at every instant in time, it is said to be compounded continuously. Okay, now, so what's happening here is that we can assume continuous compounding in our models, and we often do, because it has some very convenient mathematical properties to do it this way. Now, what we can also do is, if you need to do it for some reason, you can figure out what the equivalent continuously compounded rate would be, which brings them both to the same future value. Okay, so in other words, here, interest is 2% per 4% per year, but compounded semi-annually. In order to end up with the same final result, what would you have? Okay, so in other words, what we're going to try to do here is figure out what the equivalent continuously compounded rate of interest really is. Okay, so let's say we're told that this should add up to what we had originally, which is 1082.43. So we have 1,000, e to the r, and t is 2. So then I'll divide both sides by 1,000. And now I'm going to take the natural log of both sides of this equation. Oops, what did I do here? So that leaves me with 2r equals the natural log of this number, 1.08243, is 0.079. 2, and so therefore R would be approximately 0.0396. So basically what this is telling us is that the future value will be the same if R is 4% compounded semi-annually, or R equals 3.96% compounded continuously. Okay, so what is all of this about? When you calculate the future of the forward price, what you're basically doing is you're using the continuously compounded rate in that formula. So way back here, when we're looking at this formula right here, this R is the continuously compounded yield on a treasury bill. Okay, so this is what it represents. So the reason why we do this is typically for mathematical convenience. Continuously compounded rates of interest have certain properties that make them more convenient, especially for this type of modeling, than the other types, which are all collectively known as discretely compounded rates. So let me make a note of that here. If the compounding frequency is finite, i.e. monthly, weekly, yearly, etc., then compounding is said to be discrete. Okay, so in other words, all the different potential frequencies you might run into are all collectively known as discrete compounding, except for the case we just looked at, then it becomes continuous compounding. All right, so that's why this formula is set up this way. So when you see, when I said earlier that this formula is really nothing but the future value of S0, now you know what it means. It means if I were to take S dollars and invest them in a bank account that pays R continuously compounded for T years, I would end up with F0 in my bank account. So the F0 is nothing but the future value of the spot price. That's what this formula is telling us. All right. So that's what that formula actually means. It's the future value of the spot price when interest rates are compounded continuously. So let me do one little thing here. I want to make sure you get a copy of all these additional goodies that I've added to the notes. All right, So yes, so that's what this was all about. So the bottom line is F, the forward price, is the future value of the spot price when R is compounded continuously. That's all that it is. Now, this is a no arbitrage relationship, which means if it's violated, we could earn risk-free profits. Okay, in fact, virtually all derivatives models are arbitrage-free models. They're designed to provide us the correct price, which if violated, can lead us to arbitrage opportunities, which are risk-free profits that come about from buying something that's too cheap and selling something that's too expensive. All right, so with all that background, let's see. All right, so let's jump ahead a little bit here and look at this next example. Suppose that gold is currently selling for $1,500 an ounce, and the risk-free rate is 6% per year. I better put this in parentheses. It doesn't specifically say, I mean, that's what I meant, but I didn't put it in there. 6% compounded continuously, and the contract matures in 6 months. What is the implied 6-month forward price of gold in this contract? So again, we're still sticking with a case where the gold itself provides no income to the owners. So that's why we're using this formula. So we come down here and we can see that the spot price of the gold is $1,500 per ounce, R is 6%, and T, the time, is 6 months or half a year. So I plugged in those numbers, and you can confirm that with your calculator if you want to. And that means that the forward price of the gold for delivery in 6 months is 1545.68. And as another reminder that R is actually just the yield on a 6-month treasury bill. So this would be a simple example of how to calculate a forward price for an asset that provides no income to the owner.
I have a quick question.
Yes, go ahead.
If the compounding frequency is not stated in the question, are we to assume that it's compounded continuously?
Yes, in this class, yes, because that's what almost all the derivatives models do. It's very rare that they use a different kind of compounding frequency. I'll try to remember that, but if it's not there, yes, you can safely assume that.
Okay, thank you.
Okay, now here's another one. A 3-month forward contract is written on a stock that pays no dividends. The stock is currently selling for $90 a share. The 3-month treasury bill yield is 5% compounded continuously. I remember that time. What's the forward price? In other words, what I should say is what's the 3-month forward price, to be more precise. And so you see I plugged in the numbers. And if you have any halfway decent calculator, you should be able to do this along with me. But if you don't, you may not be aware of it, but your iPhone has a pretty nice calculator built into it. So in other words, if you take this guy out, you'll look and see that somewhere in here is your calculator app. But what you need to know, and this is a bit of a mystery, is that when you first turn it on, it's going to look like a very basic calculator, and that's because it is. But if you turn it on the side, ooh, all of a sudden, it turns into a very high-powered scientific calculator. And so you'll discover that somewhere on this calculator is a button for e to the x. So in this case, you've got 90 times e to the, let's see, let me just fill that in here. The exponent, when you multiply 0.05 times 0.25, is 0.0125. Okay, I'll turn that into an exponent right now. One of the annoying things about PowerPoint is that, unlike Word, it doesn't have a shortcut to do the superscripts and subscripts, so it's kind of a nuisance. All right, so you can see I filled in that last intermediate step, and you can see that the bottom line is that the forward price for delivery in 3 months would therefore be $91.13. Now, the reason why this is happening is because you could reproduce the cash flows of this forward contract by simply buying the asset now and investing it for 3 months. But anyway, this is the forward price. If you were to put $90 in a bank account that pays 5% per year compounded continuously, but you only put the money there for 3 months, you'll end up with 91.13 at the end of those 3 months. So that is the implied forward price of this asset. Now, what if the asset provides what we will call a known income? And that income is only paid out infrequently, like, for example, the dividend on a stock or the coupon on a bond. This is how you would adjust your formula. You notice how there's this minus I in here now, which we didn't have before. And that I represents the present value of all income that the asset will provide during the lifetime of the contract. All right, so however much income you're expecting to come out of that contract, from the asset during the lifetime of the contract, that's the present value that you put in there. All right, and so this is useful for calculating the forward price of a bond, for example, or possibly a stock. For many other cases, we can get away with assuming that the income is being paid on a continuously compounded basis. Not here. Unfortunately, here, we do have to go through all the trouble that we're about to go through. And so you'll see how that works in a second. Let's take a look at an example. So now we have to keep track of our cash flows when there's a bond involved. This could be a potentially very complicated situation. So let's just say that a treasury bond will mature in 15 months. It pays a 5% coupon annually. The next coupon is due in 3 months. The face value of the bond is $1,000 and the market price is $1,020. So the coupon in other words, the dollar amount of the coupon is $1,000, the face value, which is $50. This 1,000 is the face value. That's the price at which the bond is issued. And then this 0.05 is the coupon rate, as we call it. And that provides us, therefore, with an annual cash flow of $50. Now, we don't know when this bond was actually purchased. It's going to mature in 15 months. That's the key detail. So here's today, down here at the bottom, 0 represents today. Then you've got 3 months from now, we're getting our final coupon payment of $50, or the next coupon payment. And then a year later, we're getting the entire face value back plus one final coupon, which brings the total up to $10.50. Now we're told 2 different things, and actually this is on the next slide. The rate of interest that applies to the first 3 months here is 2.5% compounded continuously. The rate that applies for the next 15 months is 15, sorry, wait a minute. I just noticed something. I have to make sure I don't have a mistake in here. Oh, I see what's happening. Okay, no, okay, it's fine. All right, so what's happening here is that we've got a 2.5% rate of interest that applies to the next 3 months. Now, I see what the problem is. I've got something wrong on my diagram. What's going to happen is we're going to try to figure out the 6-month forward price of this bond. Okay, so in other words, the first 2.5%, this is 2.5% for the 3-month rate. The 6-month rate is 3%. We're going to need both of those. Okay, all right, so let's see if we got this straight. We start by paying, oh, by the way, the current market price is negative. It's 1,020, which means that when we buy it, we're actually paying 1,020. So that outlay is 1,020. It's a negative number because we're paying for it. The pattern of cash flows that we're due to receive are $50 in 3 months, and then a year later, $1,050, which includes the $1,000 face value plus one final payment of a coupon. So this is the face value plus coupon, $1,050. So these are the remaining cash flows that we're entitled to. So here's what we have to do. Because this is a 6-month forward price, the only income that we'll receive in the next 6 months is this first coupon payment. So we want to know the present value of that $50 using continuous compounding. All right, so let's do that. So if you recall in the formula, we have this. So we copy it down here so we can see it wherever we go. And let's see if I can make it a little bigger. Yeah, there we go. Okay, so we now want to calculate the R part, the I. So the I is the present value of that coupon payment. And so when we plug these numbers in, we've got 50 e to the minus 0.025, which is the 3-month rate. T is 0.25 because it's a 3-month rate of interest. And because what we're thinking is that 3 months is a quarter of a year. Okay, so when you plug those in, and of course, this is here to, okay. You know what we need to do? All right, as soon as we're done with this, we'll have to take a step back, another little detour. But what this is saying is that the present value of this $50 coupon is $49.6885. So the present value, you can think of it as basically the reverse of the future value. Okay, with the future value, we're trying to decide if we have X dollars today, how much will they be worth in the future? In fact, why don't I sneak that in down here? So recall the future value of a sum equals the amount that it will be worth in the future. The present value of the sum that is received in the future is the amount that must be invested today to be worth that sum in the future. And so in continuously compounded terms, the formula will be essentially the reverse of what we had earlier. Okay, so if you recall, the present value of a sum with continuous compounding turned out to be, let's see, there it is. Oh no, it's here. Okay. That's the future value of a sum with continuously compounded rates of interest. Okay, so let's put this in here. So this is the future value of a sum. The present value hold on one second. So basically what we're doing here is solving for P instead of A. And now that means that the exponent is negative. Okay, so in other words, you can see they're just inverses of each other. The only way you can really tell them apart, of course, is with the fact that here the exponent is negative and up here it's positive. So this formula that we're working on right now actually incorporates both of them. Okay, so let's get back to this one. So when we calculate the present value of this coupon payment, you can see we're doing exactly what we're doing down here. We've got the future value multiplied by e to the minus RT. Now, what do we do with that information once we have it? That goes into this formula up here. Then we plug in the rest of the numbers. Now here, this term tells me that I'm going to calculate a future value just like I did in the previous case. So basically, the present value is just to compare the value of the next coupon payment to the current stock price of the asset. And then whatever the result is then from that point on, then we just calculate the future value. That will be our forward price. All right, so if you look at this carefully, you'll see I plugged in the I that we calculated. Now, remember before we did say that we're assuming that the 6-month forward rate is, interest rate, sorry, is 3%. And this is the time frame. This is 6 months. T is half a year as a result. And then over here we have the spot price of the bond minus the interest payment or the present value of the interest payment. And so when you plug all these numbers in, this is the 6-month forward price. Okay. So in other words, what that's saying is that if I wanted to buy this bond, but I don't want to take delivery for 6 months, this is what I would pay for it in my forward contract. So I'd enter into a contract to take delivery in 6 months. Now, if you notice, the price in 6 months is less than it is today because the coupon has already been paid. So that reduces the value of the bond below the current market price. Now, I could have just as easily used the same formula for a a stock that provides a certain dividend in the future, dividends, coupon payments, they both are paid out at discrete intervals. And so that makes our job a little bit more difficult. But for cases where the interest or income is paid out on a regular basis, we can simplify our formula a little bit. And we're going to call this the known yield asset. In other words, if we can visualize that this asset, whatever it is paying out interest at the rate Q on a continuously compounded basis, then the formula is a little bit simpler to deal with. So now when might this happen? A good example of this would be a currency. If S is, let's say, the British pound, Q would be the British rate of interest. And while interest rates are not actually paid out on a continuously compounded basis, typically they're paid out on a daily basis, which means that it's very, very close to being continuously compounded. All right, so you can see the difference between the two. Before we had let's see. So the difference here is that we have to subtract this discrete term I instead of incorporating it into the exponent of E. So this is where we have discrete cash flows, as they're called. And this one is continuous cash flows. All right. All right. So we're going to use that as our example for a currency. And you'll see that it's much simpler than having to deal with the present value of a lump sum or discrete payment. And this is the one you'll see the most often in Hull's book, especially if you go through it. Most of the time we're using a formula just like this one.
Yeah, just a question actually, if you don't
Yes.
mind. Yeah, so in this case, the risk-free rate should be always greater than the yield of the underlying asset.
It doesn't have to be. No, not necessarily. R can be greater than Q or less than Q. If this number is negative, it just means that that this term, if R is less than Q, then E to the R minus QT will be less than 1. And that means that F will be greater than S. That's all. So there's no need for that to be the case. It might be the case, but it doesn't have to be.
Oh, got it.
Right.
So it's most of the time greater than R because it should be in more than the risk-free rate.
It could be, right, but you don't have to assume that.
Okay, gotcha. Thank you.
All right, sure. Now, I see in the next example, the same exact thing is going to happen. All right, so that's good that this happened. So in our example here, we're going to assume that the spot exchange rate between the dollar and the pound is $1.80, which of course is not the case. I think it's about $1.40 right now, but let's just say that it's $1.80. The US risk-free rate of interest is 3%, and the UK risk-free rate is 5%. So you can see that based on our formula, R is in fact less than Q, so that E to the R minus QT will be less than 1, and therefore F0 will be greater than S0, which is not that unusual. I mean, it happens. All right, so here's our numbers, 3%, 5%. It's a 6-month forward contract, which means that T is defined as half a year or 0.5. And then when we plug in all those numbers, okay, let's see what we get. But whatever it is, we know that it's less than $1.80. Okay, so you can see the exponent here is actually negative 0.02 times a half. And so the exponent is actually e to the minus 0.01. Now, e to the minus 0.01, it's going to be something like 0.99. I'll just calculate it right now. Yeah, 0.9, it's almost exactly 0.99. And so therefore, the forward price of this currency is 1.782, which means I could buy this for delivery in 6 months with a forward contract at a price of $1.78.2 per pound. So this is an example of the currency, which leads us up to our discussion of what's coming next. It turns out, though, that in the foreign exchange markets, forward contracts are very commonly used to acquire currency for future delivery. So we have this special result called interest rate parity. As if S is a foreign currency, R is the domestic rate of interest. Oh, and by the way, this has to be quoted as dollars per unit of the foreign currency. If not, I have to change my formula. So in other words, dollars per pound or something like that. Okay, so what happened? You know what? Let me change this. Instead of calling it the foreign currency, why don't I call it the exchange rate? Specifically, the spot exchange rate, dollars per unit of foreign currency. And then R is the domestic rate of interest. Q is the foreign rate. And T, of course, is the time to maturity of the forward rate. Or I guess you can think of it as just the maturity of the forward rate or price. Okay, so it's the same thing we just did, except now it specifically applies to a currency. And so therefore, it turns out that this has a special name in economics. It's called interest rate parity. And again, it is a no arbitrage relationship. If it's violated, we could find ourselves earning risk-free profits by, let me just sneak this in here. The forward pricing formula is a no arbitrage relationship. If it is violated, risk-free profits could be earned by buying the asset that is relatively underpriced, selling the asset that is relatively overpriced. Okay, so this is an important concept in the derivatives markets. A lot of these pricing formulas are held together by this no arbitrage principle, that if the price in the market is different somehow, then we can make profits. And in the process, we not only make profits, but also we push the prices back to their correct levels. So it won't last for long. If F is mispriced, then pretty soon somebody will take advantage of it. And in doing so, they'll eliminate the discrepancy. All right, so just to be on the safe side, I put together a nice little chart here, which shows all three cases that we considered. Just imagine yourself needing this for a test, some kind of standardized test. Well, it's awfully nice to have all this information consolidated onto a single slide. That's my opinion. I like having things organized into tables. So you just have to remember that the second case, the known income, means that the income is paid out on erratic intervals, whereas in the bottom case, the income is paid out on a continuous basis. I might as well sneak that in there. We'll call that a discrete basis because it only happens once in a while. Continuous means exactly what it sounds like. Continuous, always. It's always going on. All right, so now it's time to dive more deeply into futures contracts, which we know from last week are very similar to forward contracts, with some key exceptions based on institutional details about the way they're structured. For example, we know that one of the main differences is that the forward contracts are negotiated between counterparties, while futures contracts are traded through organized exchanges, like the Chicago Mercantile Exchange. And the nice thing about that is that it eliminates all credit risk for the investor, because the exchange is the one that takes on the counterparty risk. Okay, they guarantee the performance of all of the contracts that are traded on that exchange. So here, yes, so since a forward contract is negotiated directly with a counterparty, there's always a chance of default by the counterparty, whereas with the futures contract, the performance is guaranteed by the exchange in which it trades. No problem, so we don't have to worry about it. But here's the big drawback. Guess what we have to do with a futures contract that is not true with a forward contract? No, there's one more. Sorry, hold on. There's a third difference, and then we'll get to the marking to market feature. A futures contract may be offset by entering into the opposite futures position. So in other words, a long position can be offset with a short position and vice versa, which can't be done with a forward contract as long as it's the exact same position. In other words, it has to be the same asset, the same number of units of the asset, and the same delivery date. Otherwise, you're just mixing apples and oranges. Now, due to the ease of unwinding, I think we discussed this last week, a futures position, the actual delivery rarely takes place with a futures contract because the people who buy these are not really trying to buy or sell the asset. They're really just trying to hedge their positions. They usually offset them before the delivery takes place. With forward contracts, it's the other way around. It's very difficult to get out of them. So therefore, most of the time, if you enter into a forward contract, delivery will actually take place. And then finally, we get to talk about the part that I wanted to. With a forward contract, there's no cash flows until the maturity date when the trade is made. In other words, when we pay the money to buy the asset, or we take money in exchange for delivering the asset. But with the futures contract, potentially at least, there can be daily cash flows throughout the life of the contract because of this process called marking to market. All right, which means that you start out by putting money into a margin account, and then every day afterwards, you might have to put more money into your margin account. All right, we call that marking to market. Basically what it means is that at the end of each trading day, the exchange recalculates the value of your position to determine if you've gained or lost. If you've lost, you might have to put more money back into your margin account. But on the other hand, if you've made money, you can actually withdraw some of it as long as you don't fall below the required minimum that's supposed to be held in your account. And to make things even simpler for investors, the margin itself can be posted in the form of interest-bearing securities like treasuries. So it's not the case that you have to sacrifice interest on your margin balance. Like I said, you can deposit a treasury bill and that counts as collateral. And in the meantime, of course, you're still earning interest. All right, now when this process starts, You are required to put money into that account known as initial margin. This is like the deposit. Now, unlike the deposit on a house, the value of your deposit will be reassessed every day. Okay, depending on what's going on with your contract. You know, like it would be like, imagine if a bank asked for a down payment on the house that you're buying, and then all of a sudden market conditions change and they say, you know, we really would like to have a bigger down payment. No, it's too late by then. But here, that's exactly what's happening. It's almost like your down payment changes in value. And if it goes down, you might have to put up more money. If it goes up, you might get to collect money. So if you do have to put up more money into your account, we call that variation margin because it results from a variation in the value of your account. And the whole point of this is to make sure that nobody runs out of money. I mean, imagine yourself being the exchange and you know that if anybody defaults, you have to cover their losses. You don't like that, do you? No. You don't want that to happen. So the purpose of the margin account is to basically require everybody to put up enough margin to cover what is believed to be one day's potential losses. So that when the day is over, if you don't have enough money to cover your margin account, then your position is simply wiped out. So the exchange can never be on the hook for more than one day worth of losses from your account. That's what really this is all about. It's to protect the exchange from somebody losing a bundle of money and then they would have to pay for it. Oh, we would not like that. No. All right. Now, here's an example with a British pound futures contract. An example of an actively traded futures contract is the British pound futures contract that trades on the Chicago Mercantile Exchange. So I've written down all the contract specifications that we need to know. Well, I copied it. The unit is 62,500 pounds. In other words, if you want to buy one of these contracts, you're committed to buying a minimum of 62,500 pounds. Now, by the way, this is one of the reasons why forward contracts are so popular. What if you don't need 62,500 pounds? What if you only need 30,000 or 20,000? Well, that could be a problem with a futures position, but with a forward contract, you can ask for exactly the number you need. The trading hours are listed here for the exchange. The outrights. Now, the price of your contract the price of the exchange rate has to change by at least $0.0001 per pound, which is, I think, 100th. Hold on one second. I think that's 100th of a cent. That's the minimum price fluctuation. Anything smaller than that, they will not officially change the value of your account, which means that the value of your account changes in increments of $6.25 each. And then they mentioned that the contracts that are available cover the first 3 consecutive months. For example, if I bought a contract now, they would offer me May, June, and July. And then after that, it's only March, June, September, or December. That's it. That's all we have. So again, if you wanted to take or make delivery of this currency, let's say in August, you're out of luck. They don't have that contract. It's got to be March, June, September, or December. And this is another case where you can see the value of a forward contract. You can choose yourself whatever day you want the currency to be delivered. All right, so we have 62,500 pounds underlying this contract. And we can't do anything about that. It's all that, if you don't want that, you have to go somewhere else. Yeah, there's no flexibility here. With a futures contract, you have to take what you get. With a forward contract, it can be customized any way you like. The trading time is between that's weird. 5 and 4. I'll have to go back and double check on that. The minimum price fluctuation is 1/100th of a cent, which represents $6.25. These are the dates on which you can take delivery. But that's it, except for the first three. You must choose March, June, September, and December, or December. And of course, this is again another example of how a forward contract is far more flexible than a futures contract, because you can choose any day you like with a forward contract, not so with a futures contract, as you can see. Yeah, so the settlement method is listed as deliverable, which simply means that if you have a long position in a futures contract or a short position, if you're long, you're expected to take delivery because you're buying. And if you're short, you're expected to make delivery because you're selling. But it has to be done unless you offset the contract prior to the maturity date. But of course, they make that very easy for us so that most contracts are settled before the maturity date. That kind of thing would be difficult to do with a forward contract. So here's a simple example of this. If an investor holds a long position in a British pound futures contract for September delivery, we can offset that position by entering into a short position on the exact same contract. That would be the British pound futures for September delivery. So that way you've got two contracts, but the cash flows to them exactly offset each other. So your position ends up being zero. All right, and now finally we have marking to market, which is what we really have been interested in here. How does this actually work? So I got an example here, which I put together in a nice little chart so you can follow it very carefully. An investor takes a long position in a September British pound futures contract. It's based on 62,500 pounds. Let's say that at the moment, the September futures price of the pound is $1.26. All right, so in principle, I can lock in the price at which I pay for my pounds at $1.26. Assuming I hold the contract to maturity. All right, now, suppose that for this contract, the initial margin is $16.50, which means I have to put up $1,650 into this margin account just to buy the contract. The maintenance margin is $1,000, which means if my balance falls below $1,000, I not only have to put it back enough money to bring the account up to $1,000, but all the way up to $1,650, because that's my initial margin. So yeah, and we got to watch it. And if they call you up and say, listen, you need to post X dollars with a margin, and if you say I don't have it, that means they close out your position. And you might end up losing a lot of money just because of that. So yeah, it's a little risky. All right, now, if we have a long position, each increase in the futures price of the pound by a penny per pound adds $625 to your account. Why? Because it's 1 penny times 62,500 pounds. So if you look in the Wall Street Journal and you see that the price of the pound went up by a penny, that means you're earning $625. If it loses a penny, you're losing $625. At some point, if at any point the balance in your margin account rises above the $16.50 initial margin, then you can just take it out. It's yours to keep. So let's say your balance rises to 2,000, you can then withdraw $350, but you can't go below the initial margin. All right, so let's look at this example. Let's see if we can follow along. So here's the first day, we're at 126. And so the first day we lose just about half a cent. So if you look at that number, the difference between these two is 0.0051. All right, which is, oh, that's actually less than half a cent, isn't it? No, that's right. That's about half a cent. So if I multiply that by my position, which is 62,500, that translates into a loss of $318.75. And if you notice, that's the difference between these two amounts. So this implies that I've lost $318.75. But remember, my margin, maintenance margin, is, I forgot already. Oh, 1650. Wait, that can't be right. No, sorry, the initial margin was 1650. The maintenance margin is 1,000. So that means if my margin balance ever falls below 1,000, like I said before, you have to top it up, it's called, and put enough money back to make sure that you're back up to your initial margin. All right, so the next day we gain a little money back. In fact, I'm at 1868.75, which means I could withdraw the difference between 1868.75 and 1650, which is about $218.75. But I've chosen not to do that. As you can see, I could have done that, but I decided not to. Because you never know what's going to happen tomorrow, do you? No. So here we are. We have the price goes down again. I lose some more money. And then it's, oh no. On day 4, I lost even more money. The balance is down to $943.75. Wow. So how much money do I have to put back in my account? It must be the case that the sum of that margin balance plus my margin call is going to bring me back to my initial margin, which is 1650. So if you add those up, 943.75 plus 706.25 brings me, yes, back to 1650. And then the next day, all of a sudden, look at this. I made money, and my balance is all the way up to 2293.75. All right, so I've gone through, you can see in the slides, there's all kinds of detailed discussion of this, but we can see what's going on. So we close out our account. So what's happened here, though, is that at the end, even though we were back up to 2293.75, when you consider that we initially put up 1650, and then we had another margin call of 706.25, this implies that our total losses to this account were $62.50. We have less than we started out here. Now, you can figure that out in a different way. If you notice that the initial price of this asset was 126, and we ended up at 125.90. So you have actually lost 1/10 of a cent. Let's see. Yes, 1/10 of a cent. If you multiply 1/10 of a cent times the 62,500 pounds that this contract is written on, you'll see that you have indeed lost 62.50. So that's what I show in the next slide. How much did we lose? 1/10 of a cent, which means that you multiply that out by the 62,500 pounds in the contract, and that also means we lost $62.50. Well, that's not so painful considering the value of the position, but it's because of the way the price bounced around. So what that also means is that even though, and by the way, now you have a contract which lets you go out and buy the pounds for $1.26. So you ended up spending a little bit more than you thought on the pounds, but not much. All right. Now, it turns out, now this is an interesting result in the derivatives markets. If you look at the spot and the forward price, futures price over time, what'll typically happen is, let's say this is today. And let's say the maturity date is capital T. Let's say initially the forward price was here and the spot price was here. And of course, the spot price will bounce around. But on that date, we're guaranteed these two equal each other. If they don't, we can earn arbitrage profits. How would that work? Ooh, well, this is kind of tricky, but you'll see that when you look at it that it does work. So we'll start out with the case where F is too low. All right, so if F is below S, now remember, with an arbitrage, we're trying to figure out what to buy and what to sell. So F is undervalued. And S is overvalued. They should equal each other, but they don't. So we're going to somehow find a way to buy forward or futures, a futures contract on this asset, and we're simultaneously going to sell the spot asset. All right, so here are the steps involved. We enter into a long futures contract to buy the asset for FT dollars. We then, at maturity, we actually take delivery of the asset and pay F dollars for it, because that's the futures price that we agreed to. Once we own the asset, we can sell it for ST dollars. So in other words, the way to think about it is you paid FT, but you receive ST, and by assumption, ST is greater than FT. So therefore, your profit is the difference between the two, which is guaranteed to be positive by assumption, this assumption. Well, that was pretty clever. All right. How did we pull that one off? Well, we know what we're doing. That's why. In other words, remember, we're trying to buy whatever's underpriced and we're trying to sell what's overpriced. If we do this correctly, we are guaranteed to make a risk-free profit. Okay. Now, and by the way, in the process of exploiting this arbitrage, if you notice something interesting, FT is being purchased, the forward contract is being purchased, and the asset is being sold. So what that means then is that while this is taking place, FT is rising and ST is falling, and until they're equal to each other. So the markets will take care of this situation. In fact, it won't take long before they're balanced with each other. Okay, now what about the opposite case? Well, Now we're going to sell the forward contract and buy, or the futures price, futures contract, and we're going to buy the spot asset. All right, so what do we do now? We buy the asset for ST dollars. We enter into a short futures contract to sell the asset for FT dollars. And when the time comes, we use the asset that we just bought to deliver it through this contract. Does that make us money? Well, sure, because we're selling the asset through the contract at FT after having already bought it at ST. So because FT is assumed to be above ST, this is our profit. This term is guaranteed to be positive. So what does this mean? It means that if F is below ST, there's an arbitrage. If S is above ST, there's an arbitrage. The only way to avoid an arbitrage is if FT exactly equals ST. All right, and then there's no arbitrage opportunities. Okay, so in other words, what we've done is proven that this diagram has to hold. Otherwise, there will be lots of arbitrage opportunities for us. Lots of them. Nice. Now, this is more of a theoretical discussion. A futures price may be viewed as a forecast of the future spot price. In other words, you read about this sometimes in the literature. The forward price, futures price, I should say, the futures price reflects what investors expect. The spot price to look like in the future, or the spot price to be in the future. Well, it's hard to say if that's really true or not. This is not an arbitrage, no arbitrage formula, of course, because it is based on people's expectations, which are completely subjective. All right, subjective, meaning that they depend on people's assumptions or their judgment. Now, the relationship, what about forwards and futures prices? Are they equal to each other? And the answer turns out to be no, mainly because of that marking to market process. So if you're looking around and you're trying to decide whether you should hedge your risk with a forward versus a futures contract, the two prices are likely to be different from each other. So you have to build that into your decision-making process for which contract do we use to hedge our risk. Okay, so what it turns out that ultimately what determines this is the correlation between interest rates and the underlying asset. When the correlation is positive, the futures price will be greater than the forward price. So that, of course, tells me the opposite if the correlation is negative. By the way, you might not have seen this before. This is the Greek letter rho. And this is used to represent correlation. Specifically, here are the correlation between interest rates and the underlying asset. So when the correlation is positive, then the futures price tends to be higher than the forward price. When the correlation is negative, it's the other way around. By the way, here I see that I put in a very brief review of what correlation actually means. The correlation between two variables is a measure of how much they tend to move in the same direction. In other words, if in most periods either they're both rising or falling, then we say that they are positively correlated. And you can tell by looking at this graph, which is known as a scatter plot, that X and Y are positively correlated. Okay, the slope of this line is positive. So I'm putting together two variables that tend to go in the same direction, like sales and profits, for example. All right, when that happens, there's a tendency for them both to rise or fall at the same time. And so we have a positive trend line, this is called. Or I should say the slope is positive. And that indicates to me that the two variables are positively correlated, or in other words, they tend to go in the same direction. All right, now, of course, it's also possible for two variables to be negatively correlated. They tend to go in opposite directions. And then you can tell by looking at this plot, the trend line has a negative slope. These are variables that tend to move in opposite directions, like labor costs and profits, for example. They tend to go in opposite directions. There's also a third possibility, and that the two variables are completely independent of each other, or we can say that they're uncorrelated, which means that the trend line is flat, or the slope is zero. Oh, and in the upper left-hand corner, I put a note here that this correlation coefficient is always somewhere between -1 and +1. And that's how you can tell how strong this relationship is. So depending on how large it is, how close it is to positive or -1, the closer, the stronger is the relationship. So sometimes two variables can be positively correlated, but the connection is very weak. And that would be indicated by a low correlation coefficient. Or at the same time, it can be the other way around. If the rho is very close to 1, then you'll get a very strong relationship between the two variables. Now, so what does the correlation have to do with anything? All right, well, let's see how that works. Why is this happening? So suppose there's a correlation, the positive correlation between the interest rate and the price of this underlying asset, whatever it is. That means that when we have a surplus in our margin balance, we can reinvest that money at a relatively high rate of interest. But if the other opposite happens, rates drop, when the price drops, the margin balance drops at a time when we can finance that margin account with a low rate of interest by borrowing money. So both of these work in our favor as the investor. And so this means that the futures contract is actually advantageous relative to the forward contract. So in a case like this means that the futures price will exceed the forward price. Because now you're better off having a futures contract than a forward contract, because with the forward contract, you're not going to benefit from this effect. but with the futures price a contract you are. So that pushes up the price of the futures contract relative to the forward contract. Now, obviously, so yes, so I should have made a note here somewhere. This means that the correlation is positive. All right. Well, now all of this works in reverse if the correlation is negative. So we can jump ahead to the summary where we see that with a positive correlation, the futures price should exceed the forward price. With a negative correlation, it should be the other way around. All right. And that's how you can tell when the futures price should be higher than the forward price and vice versa. If they're unrelated, I didn't actually show that one. If this is true, then the two will be the same. All right, now there's still several considerations that we need to look at about hedging with futures and forward contracts. Okay, so let's see. Oh, it's after 7:30. I'll tell you what, why don't we stop for a few minutes right here, and then when we come back, we'll wrap these up. And now if we finish early, what we might want to do, just to avoid wasting time, is maybe take the quickest possible peek at the week 3 notes, but just a quick peek, just to make sure that, you know, we get a sense of what's going on in this chapter, which, as you can see, this is the chapter or week where we only talk about swaps. So, all right, so why don't we stop for a bit right here? We'll carry on with our discussion about hedging with futures and forward contracts, and then maybe we'll take a quick look at our discussion about swaps by stealing some of next week's material. We'll see how that goes, though. All right, so why don't we knock it off for a bit? And then I'll see you in about, let's say 15 minutes, just enough to get some refreshments. And then we'll pick it up again.
Yeah, just one small clarification,
Sure.
if you don't mind. In the yield formula, the third one where we were continuously compounding,
Yes.
so you only had one coupon payment there. So if we have multiple coupon payments, then we need to find the future future value of all the coupons and then
Yes,
subtract.
that's a very good question. I'm glad you raised that. Yes, if we had more than one, you would calculate each present value separately and then add them up, and that becomes that I term. Let me go back and see if I can find. Here it is. Yes, if there had been another coupon, then you would be calculating the present value of 2 of them.
Okay, and then
you would add them up, and that I would be the sum of all the present values of all the coupons. That's right.
Sounds good. Thank you.
Okay. All right. Any other questions? All right. I'll see you in a while. All right. All right, I guess we're ready. Oh, one more thing. Hold it. I'll be right back. All right, so we're back. Okay, good. So we looked at that. Now, hedging, yes. So hedging with futures contracts obviously is a lot more complicated than with forward contracts because we know that futures forward contracts can be customized to whatever date we need with whatever asset, with however many units we need. Everything can be customized with a forward contract. It's easy. Not so with futures contracts. Futures contracts cannot be customized. You have to choose whatever is available. Yes, there's a limited number of contracts. And of course, they also have that very annoying marking to market requirement, which you do not get with a forward contract. So what do we do differently with a futures contract than with a forward contract? All right, well, first of all, what do we choose from? Which one do we want? Well, remember the whole point of hedging is to minimize our risk. So because we have several futures contracts to choose from, maybe none of which has the right delivery date, or even sometimes the right asset, what we have to do is try to minimize the value, or the what I should say is the fluctuation of our position from one day to the next. And that uncertainty or fluctuation is usually measured statistically with the standard deviation of our position. In other words, if you look at all the gains and losses throughout the time that we're hedging our position, we want to keep the standard deviation down to an absolute minimum. Now, that standard deviation is guaranteed to be zero with a forward contract, but here it is not. So we have to make some difficult decisions when we decide on an optimal strategy for hedging our risk with a futures contract. So here's a good example. Suppose I do a lot of business in Iceland. All right. Now, the Icelandic currency is called the krona, and there is no futures contract on the krona available. So what can I do to hedge my risk? Well, I can go and use a forward contract, or I can get clever and I can say, listen, are there any other futures contracts that might have a close connection with the Icelandic krona? So I look around and I realize, guess what? Iceland does most of its trade with the Eurozone. And therefore, the correlation between the value of the krona and the euro is very high. I don't know if we have enough data here to figure this out properly, but it makes sense that when the Icelandic economy is closely connected to the European economy, that it stands to reason that the correlation between the currencies is also very high. So if I can't find a contract on the Icelandic krona, what I might do instead is try the euro, a futures contract on the euro. It won't be perfect, but at least it will reduce a very large percentage of my risk. So now, of course, if I'm doing business in Europe itself, if I'm, let's say, doing business in France, then I would pick a contract on the euro, of course, because that's the currency that I'm hedging. But if not, you can see sometimes it might be possible to find a contract which is correlated, highly correlated with the asset that I'm actually hedging. And then most likely this position will do a good job of reducing my risk. So that's something we can do. What about the delivery dates? Well, imagine a scenario where I've got a position that will take place in August. I will either need to buy or sell some asset or other. So if I hedge my risk, I can choose between a September contract or a June contract. I can't have both. So what often happens is, if you've got to pick between the two, actually, let me throw this in here as an example. Just to make this more concrete, for example, if a hedger will be buying British pounds in August, and the only available British pound futures contracts are available for June delivery and September delivery, which one should be chosen? Well, it turns out that the risk would be less in a case like this if we pick the longer maturity contract. So in this case, the risk would be lower if we choose, or if the September contract is chosen instead of the June contract. And that's because, we don't know what futures prices will look like in June. Whereas the September contract locks in a futures price. That covers the entire hedging period. So it usually works out better if you pick the longer contract rather than the shorter one. It just reduces the uncertainty over the value of our future position, and therefore the standard deviation is lower. Now, oh, and by the way, getting back to that business about the Icelandic krona and the euro, when we hedge with a different asset than the one that we actually need to buy or sell, we call this a cross hedge. Okay, I should have mentioned this a little sooner. In fact, maybe I will. Hold on 1 second. Yeah, I think this slide is a little bit out of order. As soon as I mentioned the Icelandic krona, all right, that's better. In other words, as soon as we got finished discussing the case where we hedged the Icelandic krona with the European euro, then I just want to make the point here that when we do something like that, it's referred to as a cross hedge because we're using a futures contract on a different currency to hedge our risk. And with the understanding that while the hedge won't be perfect, at least if the assets are correlated with each other, we should be able to reduce still a significant amount of our risk. All right, and then for these, now again, if there's a discrepancy in the maturity date of the futures contract and the position when you will be buying or selling the asset, remember that you want to take the longer contract. Oh, and one more detail, I almost forgot about this. If you buy the contract that matures after the date on which you need to buy or sell the asset, this eliminates the risk that you might actually have to take physical delivery of the underlying asset. So in other words, if you pick the September contract, by the time you actually buy or sell the underlying asset, the contract still hasn't delivered the underlying asset. And so therefore, it's less likely that you might accidentally have to take delivery of the asset with your contract. So there's a few reasons why we want to pick a contract that matures later than the hedging date, so to speak, the date on which you're either buying or selling the underlying asset. All right, now, the other question we have is, how many contracts should we buy in order to hedge our position? All right, well, there's a couple of ways of going about this. Now, here we're going to assume, by the way, that we have a large enough position to hedge that we can actually take on a fractional number of contracts. Well, you'll see what I mean when we get there. So the two basic approaches to figuring out the optimal ratio of hedging contracts to the underlying asset, we can try the so-called basic approach, and we can try the minimum variance approach. Minimum variance, by the way, simply means we're trying to lower the variance or standard deviation as low as possible, but this one is much more complicated than the basic approach. So really, this comes down to how much information do you have, and do you have the knowledge to carry out the more sophisticated approach? All right, what is the basic approach? Well, the idea here is that you want to hedge a position with a futures contract of equal size. Now, of course, we already know that that might be tricky given that the futures contracts are limited in selection. So, like I said before, with the British pound futures contract, imagine a situation where you're going to be buying exactly 62,500,000 pounds in the future. And we know that each British pound futures contract is written on 62,500 pounds. Then in this really perfect scenario, you would ideally want to buy 100 contracts to hedge your risk. Now, of course, it usually doesn't work out that way. The chances of it working out so nicely are pretty low. So, but what you want to do is get as close as you can to that position. In other words, you want to make sure that the value of these contracts is as close as possible to the value of your underlying position. You do the best you can. Like you might need 99 or you might need 101, but you're going to come as close as you can to the size of the underlying position. That's a very good, simple approach, and it works pretty well, but it may not be perfect. Now, on the other hand, too, what if you're engaging in cross hedging? Oh, that's right, cross hedging. So now it's a lot more complicated to figure out how many contracts we actually need. So this is our formula for figuring out the optimum number of futures contract that we should use to hedge a given underlying position. Now, what exactly do all of these terms mean? Well, H star means, of course, the hedging ratio. And let's just say we're dealing with the US dollar Swedish kroner exchange rate here. In the numerator, we have sigma. Now, this sigma is actually what it represents is the standard deviation of an asset, and that's a measure of its risk or volatility. So the higher is sigma for that asset, the greater is its risk. So here I've got the ratio of the standard deviations of the spot position and the futures position. And this correlation represents the correlation between the spot and the futures positions. All right. So more precisely, H star, of course, is the minimum variance hedge ratio. The standard deviation of S is the volatility or standard deviation of, actually, to be more precise, of changes in the spot price, not just the spot price, but changes in it. Sigma F is the standard deviation of delta F, which is changes in the futures price. And then the correlation coefficient is actually the correlation not between S and F, but between the changes in S and the changes in F. Now, you can see part of the problem here is that getting this information can be very challenging. It requires a lot of historical data to do this properly. So this is why, you might want to stick with the basic approach unless you have enough information to carry out something like this. And even then, the difference between the two approaches might be very small. So, you have to ask yourself if it's worth your while to use the second approach, but, it might be. If it can save you a lot of risk, then you might as well go for it. But it may not be worth all the extra complexity either. So you have to make a decision as the hedger as to which of these two approaches you want to take. All right, so the ratio does show us one thing, that if you look at it again, let's repeat it right here. It shows that the more volatile is the spot price, and more volatile means riskier, relative to the futures price, the more contracts we need to hedge the position. So in other words, the riskier is the spot position. The more contracts needed to hedge our risk. Which makes sense. The more that spot price bounces around, remember the spot asset is the one that's being hedged. The more it bounces around, the more contracts we should expect to buy to offset all those changes. All right, so suppose that we're an importer. I'm an American company and I buy products from Sweden. I'm buying lingonberry jam. If you've never heard of it, that's a Swedish specialty. It's kind of like I guess it's kind of like cherry jam, but it's lingonberry jam. And we're going to buy 100 million Swedish kroner in 3 months in order to buy our latest batch of lingonberry jam. Now, because we're buying the kroner, we're taking a short position on 125,000 euros. Now we're assuming that the volatility of the exchange rate, the spot exchange rate, is 20% per year. That's over here. The volatility of the futures price for this contract is, now you notice we're doing a cross hedge. There is no futures contract available in the Swedish kroner, so instead we're going to pick a contract on the euro. So the futures price for the euro and US dollar is 15%, and the correlation between the two contracts is 0.82. What is the minimum variance hedge ratio? In other words, how many contracts do we need to hedge this position? So we plug in all the numbers, and the optimal hedge ratio is 1.093. So what does that mean? Because we're buying, let's see. Oh, here it is. All right, that's in the next section. In other words, what does that tell us? How many contracts are we supposed to actually buy? Yes, the ratio is 1.093, but what does that represent? Okay, so here the actual number of contracts comes from this formula. And if you notice, one of the inputs into this formula is in fact H star, which we've already determined to be 1.093. Okay, so what about the rest of the stuff? What's going on here? Well, the NA is the number, what's the size of the position that we're hedging? So in this case, we're buying 100,000 or 100 million Swedish kroner, which is abbreviated SEK. And this contract, this number tells me how many contracts or how many units are there per contract. So in other words, what is the size of a single euro futures contract? Well, we can look that up on the exchange and see that this contract is for 125,000 euros. Okay, so if I want to buy a single futures contract on euros, the underlying security would be 125,000 euros. And so finally, this is the optimal number of contracts. Okay, so we're going to plug in all these numbers and we're going to come up with a number. All right, so remember, we're buying 100 million Swedish kroners in a few months. How many contracts do we need to hedge our risk? Okay, so when we plug in all these numbers, you can see that that turns out to be 874 contracts. Are needed. Now, I forgot to mention this earlier. The basic position, remember, this is the minimum variance approach. I just want to mention this in passing, that with the basic position, the basic approach, I'll throw that in here, I guess. with the basic approach to hedging, with futures contracts, H star equals 1. It's that simple. I mean, we don't have to do any calculations. H star is just equal to 1. And you can see why it's called the basic approach, because it's really simple. Instead, in this case, we got 1.093, which means if we'd used the basic position, we would have been somewhat under-hedged. Okay, which means we would have been exposing ourselves to a little bit more risk than we are with this more sophisticated approach to hedging. So the difference is here. You can see, so this is telling us to buy 100 or 874 contracts. If you replace this 1.093 with a 1, it turns out, and I've written it up here, that we would have only bought 800 contracts, which means we would have been a little bit under-hedged, and we would have been exposed to a little more risk than we ideally would have liked to be. So you can see why this formula, even though it's much more complicated, can really pay for itself, because it can give us the ability to take a more realistic hedging strategy and avoid leaving ourselves exposed to too much risk. But for small positions, see, here's the problem though. If we only need one contract to hedge our risk, this doesn't help us a whole lot, because it's not possible to buy 1.093 contracts. So this setup is really better suited for larger positions where we can take advantage of these fractional amounts. But for our purposes, if we have a very small position, we may as well simply use the basic position, but be aware that as the positions get bigger, it might start to pay to use the minimum variance approach. Okay, so these are the two ways we can go about this. Now, so our summary just tells us that if the number of futures contracts needed to hedge an exposure can be determined with either the basic approach or the minimum variance hedge ratio, partially depending on how much information we have, partially on the size of the position we have. If there's no futures contract on the asset being hedged, the best alternative choice is to find a futures contract on an asset that is highly correlated with the asset to which we are exposed. For example, the same case, we may use euro futures to hedge exposure to the Swedish kroner. And number 3, if there's no futures contract whose maturity date matches the date of our exposure, the best strategy is to choose a contract whose maturity comes after that exposure date. After, because it reduces several different types of risk, including the possibility of the asset being delivered. All right, so that's that. So that's our deeper discussion of forward contracts and futures contracts. Now we need to take a deeper look at swaps, and after that, we'll be looking at options. And of course, the options are the most complicated of them all. So our discussion about options will actually take up several weeks of the course. Whereas these, they're pretty complicated, but we don't need that much time to go over them. You can see that one night is really quite sufficient to cover all we need to know about forward and futures positions. There's just one thing I want to do here. All right, anyway, so I think that's enough. So now it's a little early. Why don't we just at least, like I said before, I knew this was a possibility, at least take a peek at what's coming up in the week 3 session notes. Yeah, here's a look, just to see what's coming up. Interest rate swaps and currency swaps. What exactly are we going to do in this 3rd session next Monday? Well, we're going to look at the key features of interest rate and currency swaps. We're going to learn how they're priced in the market. That we have not done yet. We're going to learn how to hedge with them. And then we're also going to take a closer look at other types of swaps that are trading in the marketplace. In other words, interest rate swaps and currency swaps represent the majority of all the swaps that trade in the market, but they don't represent the entire market. There are many other types that we could potentially use depending on what kind of risk we want to hedge. All right, so we of course have already discussed interest rate swaps. Let's see, where is this going? So some of these examples you've already seen, but where it's going to be different is that we're going to start looking at how these swap rates are determined. And we'll look at some hedging strategies. But also, most importantly, we're going to look at pricing models. How do we price these things? Where's the price coming from? And why do they have a price in the first place? So there's actually two things we can do here. We can treat the swap as a portfolio of bonds when we price the interest rate swap, or we can treat it as a portfolio of what we will call forward rate agreements, which we will discuss next week. But in a nutshell, forward rate agreements are simply forward contracts written on interest rates. Okay, so by using either of these approaches, and by the way, we're going to need a lot of Excel next week to do all of these properly. This is not something you do lightly without Excel, because it is kind of a mess. In fact, let me just go back and double check. Yeah, I've got 2 templates for swap pricing right here. And so I'll be handing those out before the session starts so we can look at them. And you'll see, yes, there's a lot going on here. We've got a page for just interest rate swaps. And you can see the calculations are starting to get fairly complicated. And then we've got 2 different versions of our foreign exchange or currency swap models, because there's 2 different ways of calculating these prices as well. So this is going to be fairly involved. But having the Excel will make things so much easier for us. All right, so that's where we're headed. Now, what else is in this chapter? Oh, like I said, in addition to all the pricing models, which you'll notice lean on a lot of the concepts we did tonight, in particular, calculating the forward prices, in particular, forward exchange rates, which we'll need to price our currency swaps. And we'll, of course, take a quick look at some of these other swaps that are out there and understand what they're used for and how their properties are different than what we see with interest rate and currency swaps. All right, so I don't want to spoil the fun. Maybe we could stop right here since we are done with this week's material. But so what I'm going to do when I send out the notes is I'm going to include this template, which is set up so you can follow along without being overwhelmed with details. How do we actually price these swaps? So we'll go through all the formulas and see how they're set up so that you can understand exactly what we're doing. All right, so I guess, I know it's a little early, but I think we covered plenty of material, and I'm sure everyone's tired. So why don't we stop here, and I'll send out later tonight, most likely, or tomorrow, your invitation for next week, along with all the new materials. And don't forget that there was an assignment due this week. This week there's one too. I think there's one every week. Let me just go back and remind myself what it was. Let's take a look at this thing real fast. Oh, okay. So you're going to fill in this table, which explains how the margin balance changes over time and whether or not there's a margin call. You're going to calculate some implied forward exchange rates. You're going to calculate some forward prices for gold. Oh, and that's it. So it's pretty quick. You shouldn't have any trouble with this at all, because we went through all of these in very great detail. very great detail. All right, so that will be assignment for week 2. And all right, so unless there's any last minute questions, I guess we can give ourselves a little extra time tonight, and I'll see you all next week.
Can you just confirm that you're going to send around the updated PowerPoint as well?
They were going to do what?
That you were going to send around the updated PowerPoint?
Yes,
from-
I am. Don't worry about that. Yes,
Okay,
that's
awesome.
coming
Thank
too.
you.
Absolutely. Yes, that's important because I added a lot of goodies to it, didn't I? Oh, yes, I did. So don't worry, that'll be coming along with everything else.
Thank you.
So if you miss something, you can look it up in the notes. And also don't forget that these sessions are being recorded and they're all safely tucked away in my YouTube account. Okay, I don't know if anyone's looked at it yet, but they're there in case you need them. Yes, definitely. I wouldn't forget about this part. I do it all the time in the daytime with the undergraduate students. So I'll definitely be sending these out as well. All right, anything else? All right, well then it's good night and I'll see you all next week.
Thank you.
Okay,
Thank you very
bye.
much.
Thank
Thank
you.
you.
Night.
Good
All right,
night.
good night.
Thank you.
Bye. Have a nice week. Thank you.
Bye. Hmm.